Dino, so the stock market tanked a little bit today.
A little bit,
What's going on?
quite a lot. Jobs report came out, weak. Non-farm payrolls were today, weak.
What do you mean?
It was weak. It was below expectations. The expectations weren't very high. So the report came low, but I think the bigger reason was the revisions to the prior 2 months. They revised down a lot. So in a nutshell, it's kind of a I told you so moment from Wednesday thing for the Fed, right? It's significant weakening in the labor market. And that's usually like a kind of like a leading indicator on softening of the economy, hence lower rates. So it was weak. I mean, it's not like the unemployment rate is still low fours, which is technically full employment. We're okay, but it's starting to show like cracks and signs that things are slowing down. I mean, you can look at many different ways. Maybe the revisions and the current report's low because the government laid off a lot of people, so maybe that's affecting it. I don't know. A lot of the jobs that came about this report was in the healthcare sector only. But I think the bigger issue, I mean, again, this is what, the narrative is. It's like companies don't want to hire right now. There's not a lot of openings right now because of they don't know what's happening. So what happens in an industry out there when you don't know what to expect in the coming months because of, one big thing is the tariff uncertainty, is you always hiring freeze. Let's not hire anybody yet. Let's see how things pans out.
People are expensive.
Well, usually that's what companies do. If there's uncertainty, the first thing they do is they like, whoa, hiring freeze, right? And at least in my experience. So that could be, a part of it. But I think from a macro level, it's just there's clear signs of softening in the labor market, which usually means softening of the economy. Even though GDP was strong in the last report, but it's skewed because all a lot of the retailers and on the goods side providers, they imported heavily in Q1, and then Q2 they just weaned off all that inventory, so the GDP was up, but it's kind of skewed. So I think the market's just like, hey, things are softening, man. Like, number one is let's lower rates in September. So the probability of rate cut in September will double today because I think all signs point to a softening economy. That's what it's pointing to. Not bad yet, not down, but softening.